Well, let me go across. We have Trideep Bhattacharya. He is President and CIO Equities at Edelweiss Mutual Fund joining us this morning. Trideep, very good morning to you. Let me first start off by getting your take with regard to earnings. How would you rate them? Stronger than expected. That's broadly the consensus. Would you say that this kind of strength can sustain? If at all you also believe that it was stronger than expected?
Good morning. Thanks for having me on your show.
Having you.
I would say that this earnings were certainly better than expected on the revenue growth side. I think on net balance, revenue growth surprised. If you look at Nifty 50 or thereabouts, about 4 to 5% on the upside. Margins and earnings were broadly in line. So net in a quarter where us, along with other people in the consensus, would have expected somewhere about 2 to 4% earnings cut, driven by the West Asia conflict and volatile macro conditions, turned out to be a flat quarter, which I think is a positive outcome versus where the expectations were. In terms of whether this can continue, I certainly do think that the India-specific negatives, which we have been battling with for the last 2 years, have kind of reached their crescendo and finally coming down. By that, I mean India was seen as an anti-AI trade as well as an anti-oil trade for different parts in the last couple of years. I think the AI trade is rolling over. I also think that while oil prices are still quite volatile, but we've probably seen the peak of oil prices. Both of these from a macro conditions are kind of are something which will help India. And finally, the earnings mojo, which seemed to be missing for the last 2 years, is gradually making a comeback. So on a relative basis, for sure, as we head into the festive season and the back half of fiscal year 27, it would be incrementally positive.
Interesting. Trideep, while the index, of course, is not a true reflection of the earnings beat, but tell me, what pools do you see going forward creating further profits?
So I think overall, I certainly think that if you look at some of the business model that we can kind of take leverage of, particularly in the mid caps and small caps, warrant attention. We need to move away from the traditional lens of investing on a market cap basis and look at where we get the best business models. And there certainly kind of, we are incrementally quite positive on mid and small cap as a domain, particularly on the mid cap segment. In areas where we particularly think this is very relevant, this could include areas of discretionary consumption, whether you look at hotels, whether you look at overall high value retail, and also as the monsoon worries are gradually receding, moving on to mass retail as well. I think in this part, or with regards to discretionary consumption, as and when the announcement comes of the 8th pay commission, that will be an additional meaningful trigger. The last one being the GST cut that we saw. So this segment of the market, I think, will do well over the next 6 to 12 months. This is also the segment where we have added to our positions, particularly in the mid and small cap domain.
Okay, interesting. Trideep, what else are you adding just in terms of the larger cap universe? Are you liking IT? Are you liking the financials? Are these pockets which you're looking at constructively?
I must admit, at the moment, I am not adding too much within the large cap universe. I'm mostly adding towards even financials. Within financials, mid cap, private sector banks is particularly an area for interest for myself. I think given that the overall credit growth in the economy has bounced back quite nicely from 8 to 10% late last year to about 16 to 17% right now, and I think could go even further up over the next 6 to 12 months. A big beneficiary of that could be the mid-cap private sector banks. Some of them have rallied to a certain extent, but I think they have better days ahead from a profitability standpoint over the next 6 to 12 months. We also like the so-called the MFI space. I think within financials, we think that, and again, that populates itself mostly within mid and small caps. We think that segment or that sector or subsector has bottomed out in terms of asset quality. And as the overall credit growth improves, they would also see better earnings growth coming through in that segment. So we are adding in those. But fortunately or unfortunately, both of them are in the context of financials are in the mid and small cap domain. On IT, if I divide the debate between valuation multiples and earnings, I would say that valuation multiples have actually, in my opinion, bottomed out. And what will also help as the AI trade rolls over, some of the positive rub-off could happen in Indian IT services names. However, the earnings growth and the earnings upgrade part is still missing. And that's where I would say that there are 2 or 3 more quarters remaining before they kind of comes in. Maybe the next guidance time of Infosys would be the time, broadly speaking, when the markets would actually get a whiff on how earnings are progressing. So given those dichotomous two parts, we are at the moment broadly neutral on IT. We think that, there are, as and when the earnings bottom out, there are better days ahead, but not yet.
Interesting. Trideep, you were also talking about the premiumization trend within retail that you foresee coming in. We have seen some select earnings and how impressive they have been. If you could just highlight, and where is it that you see investable opportunity right now within that gamut?
So, I think it's a no-brainer. Jewellery, which is doing well, has been doing well, will continue to do well in that segment. I would also point out to, I think, hotels, where there were a good bit of sort of skepticism heading into the West Asia conflict that they would be seeing some problems. They have reported generally better than numbers. And I think the back half of the year is when they actually see good amount of momentum. Those would be the two areas where I would say still there is a meaningful amount of upside that will kind of, that is remaining to be had. I also think residential real estate, which has been quite weak over the last year or so, driven by fears of AI and its impact on real estate, they are also kind of coming up with the fact that the numbers have not suffered and hence coming out of a bit of a downtrend. So those would be the 3 segments that I would say within big ticket consumption where we have added to in the last 3-6 months.
All right. Trideep, I wonder how you're looking at auto, because big ticket consumption would likely look and be auto as well, and that would slot in very well. But give us a sense, would you look at the OEM side of things? Would it be two-wheelers versus passenger vehicles versus CVs? Where is it that you would see the traction? Or would it be through the auto anchors?
So autos is more or less consensus, which is why I didn't mention, and she was talking about segments. But within autos, we've been overweight autos meaningfully over the last 3-6 months, and the stocks have also done well. I do think that we are more positive on auto ancillaries, which have done quite well as well. We think that as the global situation normalizes, we think given where currency is, they stand to benefit from taking advantage of global orders as well as Indian orders coming through. So auto ancillary remains one of our favorite picks within the segment, selectively within OEMs. And when I say selectively, I'm talking about two-wheelers and CVs is where we have been more positive on, because that's where, particularly CVs, where there have been skepticism driven by West Asia conflict. But the numbers seem to tell us the other story. So net CVs and two-wheelers are 2 places where we are positive on.
And what about defense, Trideep? I wonder how you look at that, and whether valuations, especially on the private defense side of things, have run up far quicker than what may be warranted.
So we do have some compounders in our portfolio, and we are not selling them away. However, it's not something that we are adding incrementally, given, as you said, the valuations are reasonably full. We think that, particularly given in volatile circumstances, we find that defense stocks generally find favor with investors, and valuation multiples tend to be on the higher side. However, when there's a bit of peace around, the valuation multiples settle, and that's a good time to hunt for. Directionally, structurally speaking, we do think that defense is an area where India would turn out to be exporter 2 years from now meaningfully, and hence we are gearing up for the same. But at the moment, we don't see them more than compounders. We think we can probably get better valuations to add more onto it.
Right, it's interesting. Trideep, great to have you today on the show. Thank you so much for your time. We'll let you go on that note.
Pleasure.